Okay, welcome back to the Financial Beast podcast. I, of course, am your host, your best financial friend forever, your BFF, Eric Miller, and I'm really excited today about what we're going to talk about today because one of the themes that we talk about as part of what we're trying to impart on this podcast is showing practice owners how to harness the power of their practice, build personal wealth, and then ultimately go out at the top of their game. And I don't think I could find a better guest to talk about going out at the top of their game than Mr. Roger Redman from the Ackerman Group. And the Ackerman Group, I believe, is the largest veterinary transition. I don't want to call you a broker, but I guess that's the technical term,
I
right?
don't like the word broker, but
give me a better term. Right?
Yeah. Advisors, consultants, just trying to get veterinary practice owners to where they want to be as they transition out of their practices.
And you guys are by far, I think, the largest in the industry and have done more transitions than anybody else. So I have the right guy to talk to, and I'm super excited that you're here. So I'm going to get into my first question, and here it is. And I've been consulting, advising veterinarians for, let's say, the last 14 or 15 years. Now, something happened about 6 or 7 years ago, because up for that first 10 years, I may have had 1 or 2 clients sell. And then all of a sudden there was just this cascade of people selling. And obviously you have insight on why that was. I have some ideas on why that was, but it is going to kind of go into, the current trends of where we're at right now. But what changed at that point in time?
That's a great question, Eric.
Yeah,
a great question. And I think what the private equity markets has realized with the stock market crash in 2008, and certainly COVID contributed to it, the veterinary market has remained resilient. Some of my best years as a veterinary practice owner were after 2008, and certainly during COVID. So the investment market, the private equity market, has realized it's such a economy resistant profession that they started making note, paying attention, and dumping their money there, and it's started to pay off for them.
Yeah, and ever since then, that's done nothing but, of course, when a large amount of money goes into an area, that's of course going to rise all the boats, so to speak, right? It's gonna increase the value of the entire industry, and I guess that'll lead into the current state of where we're at right now, because I know that there's a period of time there where I would tell some other, because we do a lot of business with other types of healthcare professionals, like physical therapists and dentists and optometrists. And I would tell them what some of the multiples were in the veterinary space. And they're like,
No way.
My gosh, I knew I should have been a veterinarian. Right? So they were getting up there. I mean, I saw some examples where people were getting like 18 to 20 times, their earnings, and, which was just crazy when you look at it. Right. For these types of businesses, I'm like, there's probably some publicly traded stocks that aren't going for these kind of valuations.
Yeah,
so,
without a doubt.
Yeah.
So what we saw in 2020, 2021, and even maybe into early 2022, we saw a buying frenzy. Interest rates were low. Corporate consolidators, when they purchase a practice, some of that is the money from the private equity group, but some of it's borrowed debt. So when they're borrowing at almost 0% interest rate, it really developed into a buying frenzy for them. So I was a director of business development with one of the corporate consolidators at the time, and we were buying practices anywhere from 15x of EBITDA on the low end, participated in a couple that are 20, 21x of EBITDA. I mean, could you imagine ever selling your practice at 20 plus X of EBITDA? And so then what's happened is we talk about the greater economy. I like to talk about macroeconomics and how that trickles down to the individual practice owner. We've seen the war in Ukraine pop up, and then we see, of course, the war with Russia and Ukraine. Now we got the Middle East. We've seen rising interest rates. And so the cost of capital for these corporate consolidators has gone up considerably. And they have to pay these are variable rates. So they bought these practices at 15, 16, 18x. Now they got to pay the interest on these. And at these variable rates, the rates now I've seen some paying anywhere from 8 to 12% interest rate on the debt that they borrowed at these super high multiples. So the EBITDA coming out of these practices is not, in some instances, is not creating enough income to cover the debt payment. So we've seen multiples pull back. The corporate consolidators that have done it well and not borrowed a lot of debt or borrowed at a reasonable level, they've been able to manage and their practices and expand their operations teams. So the last 18 to 24 months, we've seen multiples come down just above where they were pre-COVID. So still extremely attractive multiples.
Right.
And now the tide's starting to shift. So, and really the tipping point was when the Fed says, hey, the economy's stabilizing, our rate of inflation is dropping, and we're predicting 3 interest rate cuts in 2024. Well, what we've seen then is a lot of these corporate consolidators and private equity groups that have been on the sidelines for so long, many got rid of their acquisition team. The private equity groups have not been able to recapitalize. So for a listener that doesn't understand what recapitalization is, it's a corporate consolidator is backed by a private equity group. And those private equity groups usually run in about 5-year cycles. They'll buy or form a corporate consolidator. They'll buy a lot of practices. And 5 years later, I look at it as switching banks. They'll leave one private equity group, will switch it to a bigger private equity group that has a little more money. So in essence, your corporate consolidator you're selling to is switching banks. So that's what a recapitalization event is, and it causes a cash waterfall. So all the investors get paid out and can go on their way. Well, there's been very few recapitalization events in the last 18 to 24 months. So all these private equity groups who were hoping to recapitalize a couple of years ago now have some activity. You can hear the engine starting to churn as they think about a future recap event, potentially later this year or early next year. So what does that mean to veterinary practice owners? In order to successfully recapitalize as a private equity group, the corporate consolidator has to show all levels of acquisitions in the pipeline. So we need to, we need to see some under LOI or a letter of intent. We need to see some that are closed, and we need to see some in the organic pipeline that are going to be coming in to have an offer on the table. So we're feeling the activity starting to spur, and we're feeling the multiples starting to inch up just a wee little bit. We're never going to get back to the craziness of 2020 and 2021. So I would encourage a lot of the veterinary practice owners that are sitting around waiting for that, give up. It's not going to happen. I think everybody agrees. But multiples are still really attractive, and we expect them to be later this year.
Yeah, I mean, a 10 to 12 multiple on a veterinary practice is not bad.
No.
I mean, I think when most of these people got into the veterinary to start the veterinary practice, they weren't thinking, "Oh my gosh, I'm going to be able to sell this for 12 times my earnings." I've never met a veterinarian that had that kind of foresight when they started their practice.
Well, and the other thing I think it's important to note, so many veterinarians, because it's a small, tight-knit profession of which I'm proud to be a part of, they all compare notes. What multiple did you get?
Yeah.
And I hear that a lot. What multiple can I sell for? And my answer is multiple of what? Because, and I think it's important to point out, and maybe I'm bragging about the broker space just a wee little bit, but when I was a business development rep, I wanted to buy practices cheap. I wanted to get them as cheap as I could for the company I work for. Now that I sit on the broker side, I want the EBITDA, the purchase price, to be as high as I can get it for my veterinary practice owner, my client that I'm representing. So EBITDA, when I was calculating as a corporate consolidator, might have been a little smaller. On that same practice, when we calculate a normalized EBITDA, we're generally going to get a little higher number. So I'd be cautious of comparing with your friends. What multiple did you get?
Right.
The second question ought to fall in line with that, a multiple of what? And if you have a higher normalized EBITDA, It may be a lower multiple to get to the same, call it a $10 million figure for your practice.
Yeah.
Than if you had a low EBITDA, it's going to be a higher multiple for the same $10 million valuation.
So you were on both sides of the table then. So you've been the buyer and then you've been on the seller side.
Actually, I've sat in all three chairs, as I call it. I'm often told I'm the only veterinarian in the country that has sat in all three chairs. So I've been the seller, I've been the corporate buyer, and now I'm the broker. So it really am blessed. It really gives me a unique perspective into the space. And that's why I think I can relate so well to veterinary practice owners. I've walked in their shoes.
Yep.
And I understand what they're facing. And many of them, if you've been in vet practice long enough, you got a reasonably attractive practice, you're probably getting called on by business development folks like I used to be.
Right.
So you're in this kind of space of you've got some offers on the table in some situations, and they may look good to you. But when you get some professional counsel from individuals like yourself, Eric, and a broker, and some good sound financial consultation, you can quickly determine that offer can probably go up.
Yeah, for sure.
If you just have the right people leading those negotiations.
Well, I'll be honest with you. When we first started, I didn't have much of a line in with some of the mergers and acquisitions firms out there. And the ones that I did, I was not impressed with. And so I was kind of in that camp, like, you know what, you really don't need it. You don't need a broker. You can negotiate these things themselves. And then there came a point where when I actually saw a really competent one take a person through the process and what they got them, my mind changed at that point in time. And I was like, oh yes, this is by far the largest financial transaction of your life. Okay. And you don't get a takesy backsy on this, right? I mean, once you do it, it's it. So you have to make sure that you do this right. And you cannot be afraid to negotiate all the points. And it's funny because a lot of veterinarians would be like, well, do you think they're getting mad at me if we ask for more money,
right.
Or something like that? I'm like, do you think these guys care?
No.
I go, these are sharks. I mean, these are people that are professional buyers. I mean, they've been through the hardest hardcore negotiations that you can possibly think of.
That's
you coming back and saying, you know what, our numbers are looking a little better than what I thought. And can we somehow build that into the value? They're not going to get mad at you. I mean, this is what they do for a living. So maybe talk about that. Like don't be afraid to negotiate. But I am 100% sold now that, especially if you have a really significant practice, you need to make sure you have someone there that can hold your hand along the way.
And most of us, we don't do our own taxes. We hire a CPA. We don't sell our house without a real estate agent. And you bring up a great point. Why in the world, when you're talking about many cases, a multi-million-dollar transaction, would you think you can negotiate that on your own? And it's more than just the purchase price. In today's structure, the days of 100% cash. When I sold my practices 5.5, 6 years ago, it was 100% cash.
Mm-hmm.
Today, because of the rising interest rates and their consolidators wanting to preserve their cash, there's a significant amount of structure in these deals. So again, I'll use that $10 million valuation as for easy math. You may only get 5 or 6 million,
right,
at closing. And now you're talking about an earnout. Is it an earnout that's paid at the end of year 1, end of year 2? Is it based on your revenue? Is it based on your EBITDA? Which one's better? How do you know?
Mm-hmm.
You might have a seller's note, or the preferred shares is another way to call it. What does that mean? It's where they hold money back and they may pay you an interest rate.
Mm-hmm.
Most will offer you 3 or 4% interest. Did you know it's negotiable up to 8 or 9?
Exactly.
If you got a good broker.
Yeah.
And Topco stock in the parent company. Was it a good company? How are they valuing their stock today? Do they include the practices that are currently under LOI, or only the ones that they currently own? And when I say the word LOI, for those that don't know, it's a letter of intent. It's an engagement agreement a practice seller has written that we want to go with you, but we haven't got to closing yet. So how are they valuing their stock today? Because if you're going to get $500,000 in Topco private equity stock, does that get you 5 shares or 15?
Right.
And if you don't have a broker that can explain not only how they value it, but also what's this company's trajectory, because your payout on that Topco stock is going to come in future years. Is this a company you want to be aligned with or not?
Right.
Do they have a great operations team? What is their track record of growing practices? So, there's so much to understand.
Yeah. And to your point, because I think a lot of what we heard 5 years ago from some of these corporate groups when we would look at clients' offers and everything like that was, you roll over some equity and whatever strategy that you had just mentioned. And then that second piece of the pie, so to speak, could be more than what your first piece was.
Right.
Now, unfortunately, I just haven't seen it just because there hasn't been, like you said, there hasn't been a lot of recaps. So I kind of always caution people, make sure the first bite of the apple is more than enough than what you need, and let that second bite just be a cherry on top, because
that's exactly right.
You don't know when it's going to come. You don't know, they have complete control over the outcome at that point in time, and you really don't. So when you're dealing with a veterinarian and you're looking at like the structure of that, like what questions do you ask them to help kind of mold a deal?
Yeah, that's a great question. Well, the first question asked is, where do you want to be?
Yep.
I mean, how old are you? How many more years do you want to work? I want to understand what their future desires and wishes are. Because again, the days of selling and leaving within a few months, over.
Right.
They want to mitigate the risk. So if a veterinary practice owner is contributing any significant revenue to the total revenue of the practice, they're going to be asked to stay at least 3 years.
Yep.
With some groups, it may be longer. So if you're, I'm helping a 77-year-old woman right now sell her practice. So if you want to be out quickly, we need to set your practice up in a way that you can exit quickly. And that might be putting more onto your associates, hiring a new associate. There's all sorts of ways we can mitigate that risk. But I want to know what their wishes and desires are for the future, and then we'll try and create a sale around that. So a great example is a joint venture. So we talked about Topco stock. That's investing in the company.
Right.
You have no control over that. The alternative is hold on to a percentage of the ownership in your own practice. And that's called a joint venture, where you can sell maybe 60, 70, 80%, get paid for most of that, not all of it. Some of it will be in other forms of payment down the road, but the rest of it you hold on to yourself, and that's when you're investing in you. And you know what your team can do over the next several years. And in most of the companies, when they recapitalize, that valuation, there will be a number determined today based on a future recap event that you will get paid on the EBITDA of the practice at that time, times your percentage.
Which should be higher, hopefully.
Which should be higher. Better. Yeah. They have better buying power. So that lowers your costs, raises EBITDA. They should help you with reminder systems, client recruitment, efficiencies of scale. So your EBITDA should go up if everything is performing properly, and you take the second bite of the apple later when that recap event happens. But again, going back to the importance of a qualified broker, a good broker should negotiate what that exit multiple is today, what it's based on.
Yes.
So it may be based on the corporate level recap multiple. Or some cases it'll be, we call this a tag along, right? When they recapitalize, you can tag along, but many will say we'll give you the corporate level multiple -2 or -3. So if they recap at 19, you get 16 or 17x times your percent times the EBITDA of the practice. And you do the math, and that's a pretty significant chunk of change. But again, it goes back to a advisor that can negotiate those numbers for you, different from the first number that may be offered to you by a business development rep.
Yeah. And I would say that the joint venture would probably be for someone that, because I've had a couple of people that have done that, and they were, they weren't at like the 70, 75 years. I mean, these were guys that were in their 50s. They still wanted to they still wanted to treat.
Absolutely.
They weren't necessarily done with the game, right? I mean, they still had some desire to be part of the practice and wanted to see it continue to grow. And I think that definitely was a fit, because they could get percentage of the profits too, and they get draws and
right.
Yeah,
that's
and
the
really
other upside.
I guess the only negative thing that I've ever heard is just their relationship with the corporate on-site management team, or whatever term that is. Like, I've seen where that's been good and where that's not been so good.
Right.
And if people give me feedback and we listen to it, that seems to be the only downside. I guess one of the downsides of selling a corporate is that you do have to have a relationship with whatever that. I think they have like regional management teams that are responsible for the different practices that they buy. Yeah.
And you bring up a really hot topic for me, Eric, and I appreciate you doing that. It's so often I hear veterinary practice owners say, I love Joe at VetCor, or I love Jason at CareVet, or you got to remember, you're never going to work with that individual again.
No.
Or I hate this company because she made a negative comment at dinner. Don't love them, and don't love or hate the company because of the business development rep that took you out for dinner. So one of my requirements as a broker, and probably because I'm a veterinarian that owned and still owns practices, is before we sign a letter of intent, we can negotiate all the terms, all the prices, all the numbers. But before I'll let my client sign it, I want them to meet the director of operations, the regional practice manager, and I want them to meet the regional medical director. These are the people you're going to work with.
That's so smart.
And I've seen some groups, when it goes sideways, it's usually a personality.
Yes.
It's not necessarily a bad company. It's a bad personality that's in the mix. And you want to make sure that all that culture and fit aligns. And so our motto here at the Ackerman Group is best fit, best terms, best price.
Yep.
My job is, and my responsibility to my client is, when you find the company that has that best culture and fit, maybe we've got 3, 4, or 5 offers. My job is to align best culture and fit with the best price. And let's find the one you like from a culture and fit perspective, and let's see if we can negotiate the terms and the price so they align, so that when we're done, we have all 3 of those have risen to the top. Culture, fit, the culture, fit, terms, and price. I think that's extremely important to a seller.
Yeah, I can't stress that enough. I think that if you just go into selling and you're just looking for best price, or who's going to give me the most, it's such a mistake.
Yeah.
You have to be a little bit more, I don't know, a 360 view or whatever term you want to call it. But, I try to tell people all the time, the decision that you make to transition has to not only benefit you personally, has to benefit the staff, has to benefit the community, has to benefit the person that's buying you. All these things have to be in place so that
and your team.
And your team.
The team that works for you. In my practice, that was my family. I spent more time in my practice than I did with my spouse. So I think most veterinary practice owners would agree with that. You spend an awful lot of time with your team.
Yeah, that's for sure.
The analogy we use in this space is like a marriage. Mm-hmm. So when a practice is launched into market, you're dating.
Yep.
You're going to go out for dinner with these various reps. You sign the LOI, the letter of intent, to go with one company. Now you're in the engagement phase. And then, of course, closing is marriage.
Yes.
And I would encourage anybody that's trying to do this themselves, don't marry the first one that comes along.
Yeah, for sure.
Go out and date a little bit.
To go back to that employment agreement too, that's negotiable as well, right? I mean, all these points are negotiable,
very much so. That's what we talk about, terms.
Right.
So if somebody tells me we want to be out in 2 years and all the offers say you got to stay 3, then my job is I'll negotiate. Maybe you can drop by 50% in year 3.
Yeah. Okay.
So there's all sorts of things we can negotiate into those terms. I'll even negotiate lease terms in the letter of intent. Like, who replaces the HVAC unit, the furnace?
Right.
And after so many years of a lease, at some point, the tenant should replace that if you own the real estate. So I'll negotiate as much as we possibly can in the letter of intent so that we don't rely on a set of attorneys to interpret how it should be
Yes.
done in the legal documents. So we can reduce that stress on the selling party.
Yes. Let's talk about preparation. And, I try to tell owners all the time that, you have to start preparing for your exit. I mean, ideally, when you start the practice. Now, I know that's probably not very practical, and because most people are just trying to figure out how to grow the practice and such, but it is something that you really have to think about when you're at some point in time of how I'm going to transition out. Now, selling to corporate's not the only method. I mean, there's other methods that you can do to be able to, and there's pros and cons to each, I would say. Maybe talk a little bit about that. Have you seen would you guys help people sell in different methods besides selling to corporate?
Well, we specialize in the corporate sale, but we have co-brokers we work with. So if it's well, I'll back up and tell you, we got a quagmire, I call it, in our profession right now. We've got the 2 DVM or greater practice.
Mm-hmm. Yeah.
$1.5 million in revenue or greater, and decent demographics. It's not rural Iowa, because consolidators don't necessarily want to be in a 2-doctor practice in rural Iowa. They can't recruit to the area. So decent demographics, somewhere semi-close to a major metropolitan community.
Mm-hmm.
So all those fall under the corporate radar, and they're fairly easy to sell. The quagmire is anything less than that is really difficult to sell. Now, if you're in good demographics, you're 1-doctor practice in Chicago, New York, Denver, we can probably sell that.
Yeah.
In a doctor-to-doctor transaction, occasionally in a corporate transaction if it's just an outstanding practice. But I'm on the phone 2 or 3 times every week with a veterinary practice owner that has the smaller practice. And it just, in a doctor-to-doctor transaction, when we look at the data, they're on the market at least a year. There's more change in those sales within the practice than a corporate transaction, believe it or not. Because you got a new owner, a new guy or gal coming in, old owners out, and we're going to change prices. We're going to change software. We're going to change, so a lot of change goes on with the doctor-to-doctor sale. But the valuations generally half, 4 to 5x of EBITDA.
Mm-hmm.
We've already talked about, the market today is 9 to 13x.
Yeah.
So, it's just, there's a big space of opportunity there. I think if somebody figures out how to fill that void, there's some real opportunity there. I personally have bought a couple practices that have been in that void, put in some good management, some good veterinarians, great team, and to grow those revenues to north of 1.5-2 million, and suddenly you're on the corporate consolidator radar.
Yeah, and there you go.
There's opportunity there, and a lot of veterinarians have figured that out that are entrepreneurial.
Yes, and I think that's
practices up.
And this is the mind shift that needs to, the mindset shift that needs to take place with a lot of them, is that they treat their practice like a job and not an investment.
That's right.
And when you treat it like a job, you're just going there 9 to 5. I'm going to check out, and then I'm done.
That's right.
And there's only so many bricks a bricklayer can lay in a day, and that you're going to plateau at some point in time. And then, what suffers is the value of the practice at that point in time, because, you're, what, I'm only going to work 4 days a week now instead of 5 days a week. And then I'm going to go down to 3 days. And then all of a sudden it just starts to trend downward.
Sure.
Like that.
Sure. And your question was preparing for the sale.
Yes.
And you're right. Not enough veterinary practice owners prepare well enough in advance for a sale. So I like to say at least 1 year prior.
Yep.
Preferably 2 or 3 years prior. And one of the first things you should do is get a valuation on your practice.
That's
and we'll
a good
do
start.
If it's a practice we think that has ability to sell either now or in the future, we'll do a complimentary, we call it an evaluation. It's a high level normalization.
Mm-hmm.
Doesn't cost them a dime. Our hope is they'll use us to represent them when they do decide to sell. But we'll do an evaluation, and I'll sit down and spend an hour, hour and a half walking through the various expense buckets on their profit and loss. We'll normalize it the way a corporate consolidator will normalize it. We'll review those expense buckets. COGS, for example, cost of goods sold. There may be an opportunity. So I'll lay out 3 ways they can improve their COGS. Non-DVM labor is one that we've seen, especially I think as we've come out of COVID. Everybody staff was wanting higher pay. We gave it to them so they wouldn't leave. And now we're seeing a lot of high non-DVM labor costs in relationship to total revenue. So I'll sit down, spend an hour, hour and a half trying to figure out ways they can improve their efficiencies, improve their P&L, which ultimately increases their EBITDA, their earnings, which is what the valuation is going to be based on at the time of sale. And I might work with a seller 2 years doing this before they're able to sell to a corporate consolidator. So plan ahead.
Yes.
In that, and get some good advice and consultation if you don't understand what a P&L is.
Yeah, and let's even dig deeper into the different areas, because you're right. I mean, there is a big difference between a practice selling for a 13 multiple and a 4 to 5 multiple, right?
Yes.
So what if I want to sell for that in that higher range right there? What are some characteristics that I should be shooting for to qualify me for those higher valuations? I think you had mentioned first, obviously, you have to have a multi-doctor practice. It just can't be, one and a half to 2 doctors. It's got to be probably more than that.
That's right.
And then I don't know if the EBITDA range needs to be at a certain percentage or a certain dollar amount. Is that?
Yeah. No, that's an excellent topic. So, the bigger practices, 4 DVM or greater, $750,000 of EBITDA or greater.
Okay.
Decent demographics.
Yep.
Near major metropolitan cities. Those are 13x.
Okay.
And I think maybe a tad higher as we go into 2024. So those practices, there's a lot of desire on the part of the corporate consolidators for those. The majority of the practice owners that I talk to are 1.5, maybe 2 DVM, but their profit and loss statement is miserable. So COGS is running at 30% of total revenue. COGS cost of goods sold. But I kind of pause there because a lot of veterinarians don't understand what COGS is.
Yeah.
Cost of goods sold is products you buy and you resell. So you buy oxygen, you sell surgery. You buy suture material, you sell a surgery. You buy a lab kit, you sell profiles.
And what should that percentage be?
It's going to depend on the practice and how much product sale they have. But generally around 23, 24, 25%. We want it under 25% in most practices.
So if you're at 30, 32%, which a lot of practices are, it's the first thing that we see. You have a problem with inventory, and whatever that is, you need to get that under control.
Sure. And that's a big one. Yeah. So, a corporate consolidator may look at a 32% and say, oh my God, this is a poorly managed practice.
Yeah.
The next consolidator may look at it and say, we're going to add 7, 8, 9% margins to our bottom line the day we buy it.
Right away.
So, there can be an upside. But you know what? You as the practice owner is giving that up. You add 5, 6, 7% to your EBITDA. A 15% EBITDA rise to a 20% EBITDA. Do the math on a $1 million of revenue.
Yes.
Now you apply that to a $4 million revenue practice. That's a huge swing in your valuation. So EBITDA, I would tell you the average practice is somewhere between 15 and 20% EBITDA. We see really well managed practices 25, 28, 30%.
Yep.
Anything above 28% EBITDA margins. And again, for the practice owners that may listen to this, when we talk about EBITDA margins, it's what percent your EBITDA is of your total revenue. That's the margin. So anything above 28% EBITDA margins, you're not going to get paid on that.
Okay.
And I see some really well-run practices that are 32, 34% margins. You're not going to get paid on that. But if you got a great broker, you can negotiate future earnouts and convince the consolidator, hey, we can keep these margins going for you after you buy us. And if we're able to do that, I get an earnout at the end of year 1. I get another earnout at the end of year 2. So you're going to recapture some of that value you lost at the time of closing. Again, something that can be negotiated at the prior to the time of sale.
Good. So we talked about the EBITDA range, the demographics. What else can a practice owner do to make to qualify them for a higher multiple?
The right team in place.
Okay, good.
So often we forgot about the team.
Yeah.
A lot of practice owners call me out of frustration. Can't find a vet. Right? Can't find a vet. I've been looking. I've been trying forever. How many times have we heard that?
5 years. Yeah.
I can't find a vet. I've tried and I can't find a vet. And I'll Google it. I can't find an ad. So tell me how you're trying to find a vet. So get the right team in place. And when I'm talking about team, a corporate consolidator is not going to really look at your support staff with a close eye. They're going to look at your associate veterinarians. What ages are they? If they're all north of 65, that's a high risk practice to buy because they know they're going to have to go recruit in the next few years. If you've got veterinarians that associate veterinarians have a history of they haven't been on board very long, well, maybe they jump ship a lot. So you need to look at your associate veterinarian team and make sure it's whole. And how are you going to keep it whole? Because if one associate leaves in a 3 DVM practice prior to closing, here's that bad word, selling to corporate, and they decide to leave, closing's likely not going to happen. You can't sell your practice. So think about how you're going to compensate this associate DVM team. Do you have, first, what's this team look like? How are you going to compensate them so they stay? If you partner with a group, a consolidator that offers 100% sale, maybe then you're going to need to cough up some retention bonuses that are paid out to them. I love joint ventures. We talked about that earlier, but joint ventures is you retain some ownership in the practice. Now let's gift some of that ownership to your associate veterinarians. So they've been earning this salary all along. Now they're going to have this little bump up. You're going to give them some equity in this joint venture. They're going to get some distributions out of the practice, some profit as you go forward. And remember that recapitalization multiple we talked about earlier when you leave your joint venture? Now your associates get to participate in that.
Yeah.
So you can often have a young associate that has a ton of student debt getting a check for $300,000, $400,000, $500,000 in future years. That's quite a gift.
It is.
And I talk a lot in joint ventures about you want all the people in the same boat, and then you want them all rowing in the same direction. In a joint venture, that's extremely important. Have all your associate DVMs in the same boat, rowing in the same direction, because remember, you're all getting paid out on future EBITDA.
Yes.
So let's incentivize them to row as fast as you're rowing.
That's great.
To get there before the recapitalization event occurs.
Yeah. I mean, this makes sense. I mean, demographics, your team, your profit, all these things, having multiple doctors. I mean, these are all things that look, if you want to get the high multiple, this is what you're going to have to do.
Set the practice up for success. Yeah.
To be able
to start planning ahead of time.
To be able to do that. And then just from, because we talk a lot about just trying to create order, I mean, we'll find that a lot of DVMs, like we ask, like, hey, where are your corporate records at? Have they been updated? And they're like, oh, what?
Yeah.
What's all this? Or, can you get your profit and loss statements to us, quickly, or do I have to go through 7 people and takes like 6 weeks? And I can only imagine that as a buyer, you start asking for financials and it takes forever to get them. That is a bad sign to a buyer.
Exactly.
I would say, isn't it? Yeah,
it is. It is. And this kind of ties into preparing ahead of time. Listen, everybody runs personal expenses through their P&L. That's
sure.
Okay. Maybe lump them into one category. So as a broker, we can pull those out. We'll normalize those. I've seen the airplane, the hangar, grandma's nursing home care. I've seen it all on a P&L. It's okay. We'll pull it out when we normalize your P&L. But stay timely. And if you've got a CPA or a bookkeeping firm that's only doing it quarterly, they need to do it monthly. Because once a practice is launched in the market, those buyers are going to say, we need updated financials.
Yep.
So like I just launched one this week, but we're working with financials that were through last September. That's the soonest we could get financials from their CPA bookkeeper. So And if it means switching bookkeeping firms,
It's not
I'm
hard to
sure
do.
it's not
Yeah.
hard.
Yeah.
Find another one.
Same with the CPA. You know, people are like afraid to leave their CPA. I was like, you can work with a CPA anywhere.
That's right.
Right. It doesn't necessarily, and it doesn't take much to switch CPAs. So
yeah, good advice. Timely records is extremely important.
Yeah, I would assume that would be okay.
Well, and you bring up a great point that I think ought to be commented on. If you're trying to sell your practice yourself to corporate consolidators, you're going to get in those financials and giving it to Group A. Now Group B comes along. Now we got to go get different financials and give those to Group B because some time has passed. Oh, no, Group C showed up. Now we got a different set of financials. Now you're comparing 3 offers from different stages in the practice, and you're not comparing apple to an orange, or you are comparing apple to an orange, not an apple to an apple. So how are you ever going to compare those 3 offers when they came in 3 different stages? So again, that's where I think with the broker, you're providing financials once, and we're going to launch it to 35 plus groups.
Yeah.
So you're sharing data one time.
Yeah. So definitely get your house in order as quickly as possible. It's just good. Number one, it brings order on the money lines. And when you have disorder on your finance lines, it just leads to lower profits and money leaking and getting ripped off and all of those things that, you know, I'm sure we've had horror stories from everyone. Kind of going into the building the financial team as well. I know that, you know, me working with veterinarians as a financial advisor, you know, I'm responsible for the person's personal financial condition. I just learned early on that if I didn't know something about their biggest investment, which was their practice for the most part, I was doing them a disservice because there's a ton of cash flow that goes through a practice. And if you don't have someone that's thinking more like an owner investor of how do I extract some of this money so that I can personally benefit from it, because it's okay for a veterinarian to have money personally.
That's right.
Right. It's okay. It's not, you're not doing anything wrong by taking distributions and creating other income sources and, you know, getting out of personal debt and all those things. I mean, the practice is there to serve your household. And I talk so much about that, but you know, if I didn't understand the veterinary business as just like like a Merrill Lynch guy or a Raymond James guy, I mean, I'm just looking at your personal portfolios. So I think there's a lot of value in working with people that understand your industry.
Without a doubt.
You know, maybe talk a little bit about that from your own experience.
Yeah, no, that's a great point, because a lot of the financial planners like yourself have heard of a VetCore. Have heard of a VPP. They understand the structure and how it's going to get paid out. So I think it's invaluable. And so now when we talk about it's your biggest investment that you have, you've got millions of dollars coming to you, and maybe in different steps. Some is cash at the beginning, some is tax deferred. You need a sound financial advisor to help you in this transaction with the tax strategy, tax mitigation strategy around it. As a broker, I'll help with the asset allocation, which buckets get money,
right?
Hopefully getting as much as we possibly can into the goodwill bucket. So as you know, that's the lowest tax bracket. But then working with a sound financial advisor, financial planner, that now how's this money going to get dispersed? So you're well diversified post-closing. Extremely important.
Which, you know, we've had some horror stories there of people that have worked with, you know, kind of local advisors and everything. And, you know, when you get $8 million, it's not like I'm just putting $500 of my paycheck into my 401k and investing it accordingly. You're getting a huge lump sum of money. The investment approach, the thought of how do I manage the risk of this? I don't need the performance anymore. I mean, of course, you want rates of return, but I made the money. Like the performance was on the sale of this practice that I worked on. I have to preserve this money. And I've encountered some veterinarians, especially I think it was like 2020, 2021, they had, sold for $10 million and then, they just lumped it all in the stock market and then they're down 30%, 25%. And like, oh my God, so there's gotta be an intelligent, it's a different investment approach to when you get the lump sum of money. than, what you've been doing in the past. So that's why, again, I think you have to be, definitely have a team that understands the sales process and, making sure that you have income for life.
Right. Well,
100%.
and veterinarians are some of the finest people on the face of the earth.
They are.
Some of my very best friends are veterinarians, but and many of them, unfortunately, says, I've got enough money in my bank account. That was the measure of success.
Yeah.
And I can think of one right now in Indiana. He had lots of money, but it sat in a bank account.
Yeah.
And I think it was in the millions. He just never invested. And I had the ability to get them tens of millions of dollars for their practice. That wasn't important to him.
Yeah.
Until I asked about his kids. And this is about potentially preserving wealth and a legacy to leave for your children and your grandchildren. And then when he started thinking in terms of that, his concept, his perception changed, and how he wants to preserve this wealth, invest wisely, find a financial planner that can help him do that. But the whole mindset changed because all he looked at was the balance in his bank account.
That's so funny. Yeah.
And he was comfortable in his home.
Yeah. I mean, people get content. It's very easy to do. And, I think if you don't have a plan with the money, there's two things that we've seen happen. Either it gets misallocated, malinvestment, because, when it's so funny, like when someone is about to come into a lot of money, it just seems like all the sharks come in at that point in time. Like, I haven't heard from my Uncle Joe for so long, but all of a sudden he has this wonderful investment opportunity, right? And then everybody kind of, it's so funny how it attracts the shark. So, two things happen. You either misallocate it, or you don't do anything, just like your example right there. And it just sits in a bank account, earning 2 or 3%. And I guess that's better than losing it. But, you still have to put it to work at some point in time. So,
and we like to align our clients, our selling veterinarians. We like to align them with people that have experience in the veterinary space.
Yes.
So, and that starts often with not only CPAs, but probably even more important, the attorneys. Because now you've signed a letter of intent, there's going to be a whole lot of legal documents coming. There's going to be a lease agreement, employment agreement, an asset purchase agreement, so on and so forth. Get with an experienced attorney that has done veterinary specific merger and acquisition in the corporate consolidator space. And I'd take it one step further. You're selling to a vet corp. Let's find a law group that's worked with vet corp before. They know what they can negotiate and what they cannot. And the same goes for you and your firm, Eric. Just align yourself with a group that has experience, understand what a vet corp structure may look like, and specifically help the veterinarian because they're experienced in that instead of some fly-by-night financial planner.
Yeah. Hey, give me your best transition story. Do you have one? Like a favorite?
You're probably looking at it.
Okay. Yeah.
When I sold my practice, it was 100% sale. I think there's two things. There's, when you say best, there's the best for your team.
Yeah.
And then there's the best financially. As I look back 5 years, probably didn't end up with the best financial result. I probably could have gone a different direction and done much better. But every member of my team was still in my practice 5 years after I sold.
Wow.
Except one. She was a veterinary technician, and I had been able to buy another practice the next county north, and she lived closer to that one. So we got permission from the corporate consolidator that bought my practice for her to leave and go join the practice I currently own the next county north. It was far enough away. There was no non-compete issue, but it just, to me, it spoke to, I chose the right team for the right culture and fit for my team. And that's
amazing.
That means everything to me. That's when I walked in the practice. I wasn't able to go in for quite some time during COVID, but I walked in after COVID. Boy, my heart just that's the greatest success story I've had.
That's amazing. I love it. Well, I think we'll end off on there. Roger, we could probably talk for another hour and a half on certain things, but I do appreciate it. How do people get a hold of you or the Ackerman Group?
Certainly. Yeah. So my email is roger.redman@ackerman-group.com. You can certainly go to the Ackerman Group website, look us up. Comes up as Ackerman Group Veterinary Transition Partners. You can click on a link there or contact me directly. My cell number is 330-466-0103. And feel free to give me a call, shoot me a text. If you'd like to talk about your own individual practice or even have us do a complimentary valuation, happy to do that for you.
Love it. All right. Well, thanks so much. And guys, we'll see you on the next podcast. Be well.
Thanks so much, Eric. Have a great day.